In 2008, as the financial world was collapsing and one so-called Wall Street guru after another was declaring bankruptcy, a relatively unknown Jewish investor named Seth Klarman was doing something that baffled the entire market. He was buying assets that everyone else was panic selling. But he wasn't doing it out of bravery or intuition. He was doing it because his way of thinking about investing was fundamentally different from the rest of Wall Street. While the famous gurus were looking for the next hot stock that would double their money in weeks, Klarman was after something else entirely. Assets so undervalued that even if the world got worse, he would win. This difference in mindset isn't accidental or a product of luck. It's the result of an investment philosophy that has been refined over centuries and contradicts almost everything modern gurus preach in their podcasts and self-help books. And the most interesting thing is that these differences aren't in technical strategies or chart analysis. They're in something much deeper, in how they define risk, success, and the very purpose of investing. The first major difference is something that sounds almost heretical in the modern investment world. Jewish investors don't pursue maximum return, they pursue maximum survival. While a Wall Street guru boasts of having earned 50% returns in a year, a Jewish investor asks himself, how many years in a row can I earn 15% without ever losing a single year? This mentality has a deep historical origin. When your ancestors were expelled from entire countries, when they saw fortunes confiscated overnight, when they experienced that permanence is more valuable than explosiveness, you develop a different instinct. You don't ask yourself, how much can I earn? But rather, what is the risk-reward ratio? Warren Buffett, who has extensively studied Jewish investment methods, has a famous quote that captures this philosophy. Rule number 1 is don't lose money. Rule number 2 is don't forget rule number 1. But even Buffett doesn't take this to the extreme that traditional Jewish investors do. For them, avoiding losses isn't just a priority. It's an almost religious obsession. Carl Icahn, one of the most successful activist investors in history, has a personal rule that perfectly illustrates this mindset. He never invests in anything where he stands to lose more than 25% of his capital, no matter how large the potential gain. If an investment can make him 1,000%, but there's a chance he could lose 30%, he simply doesn't do it. This discipline sounds restrictive, but it's exactly what has allowed him to stay in the game for more than 50 years while generations of gurus have come and gone. The second fundamental difference is how they define time. Wall Street gurus think in quarters and fiscal years. Jewish investors think in decades and generations. This isn't just a difference in time horizons. It's a difference in the very nature of what they're building. When a Wall Street guru makes an investment, he asks himself, when can I exit this position at a profit? From the moment he enters, he's already planning his exit. A Jewish investor asks a radically different question. Would I want my grandson to inherit this position? If the answer is no, he doesn't invest, no matter how promising the short-term profit seems. This mindset creates a completely different investment filter. It automatically eliminates all fads, all speculative bubbles, all opportunities that depend on perfect timing. What remains are investments in core assets, businesses with real competitive advantages, properties in strategic locations, companies with brands that transcend generations. The Pritzker family, owners of Hyatt Hotels, bought their first hotel property in 1957. Almost 70 years later, they're still in the hotel business. They haven't jumped from industry to industry chasing the next big thing. They've built up a composite knowledge base in a specific sector that no one can now replicate. They understand hotels better than anyone else in the world because they've been in the business for 3 generations. That's a competitive advantage no guru with his revolving portfolio can develop. The third difference is perhaps the most counterintuitive. Jewish investors value liquidity differently. Wall Street gurus are obsessed with liquidity. They want to be able to enter and exit positions in seconds. Jewish investors do something strange. They deliberately seek out illiquid investments when they find real value. Why? Because they understand something about human psychology. Liquidity tempts you to make emotional decisions. When you can sell something with a click, every market dip is a temptation to panic sell. Every negative headline, is an invitation to fear. Illiquidity is forced discipline. Leon Cooperman, founder of Omega Advisors, has a principle that surprises many. He prefers investments he can't easily sell for at least 5 years. Why? Because it forces him to do in-depth research before investing. If you know you're going to be stuck with something for 5 years, you don't invest based on rumors or trends. You invest based on thorough, fundamental analysis. This is why many successful Jewish investors hold large positions in private businesses, real estate, and family businesses where liquidity is limited or non-existent. It's not despite the illiquidity, it's because of it. It gives them a competitive advantage over hyperactive traders who need to be able to exit at any time. The fourth difference is how they use information. Wall Street gurus are obsessed with having more information than everyone else. They pay fortunes for exclusive data, artificial intelligence analysis, and access to legal insider trading. Jewish investors do something different. They assume everyone has access to the same information, and that their advantage lies in interpreting that information differently. If you find this video helpful, please give it a like and subscribe to the channel so you don't miss our next content. Howard Marks, co-founder of Oak Tree Capital Management, has a concept he calls second-level thinking. First-level thinking says, this company reported excellent earnings. The price will go up, I should buy. Second-level thinking says, this company reported excellent earnings, but everyone already knew the earnings would be excellent, so the price already reflects this information, and if expectations were even higher, the price might go down despite the good news. Jewish investors live on this second and third level of thinking constantly. They don't care what the news says. They care about what the news means in the context of what everyone else already knows and expects. This is why they frequently make moves that seem contradictory. They buy on bad news and sell on good news because they're operating on a completely different level of analysis. The fifth fundamental difference lies in their relationship with ego. Wall Street gurus build gigantic personal brands. They appear on television, write best-selling books, and give lectures to packed audiences. Their success is intrinsically linked to their public visibility. The most successful Jewish investors do exactly the opposite. They cultivate deliberate invisibility. Have you heard of Sheldon Salo? Probably not, even though he built one of New York's largest real estate empires. Have you heard of Leonard Blavatnik? He owns Warner Music Group and is worth over $30 billion, but he deliberately avoids the press. This invisibility isn't shyness, it's strategy. They understand that visibility attracts scrutiny, competition, and envy. When you're famous, every move you make is observed and copied. Your competitive advantages evaporate because everyone can see exactly what you're doing. But when you operate in the shadows, you can accumulate positions for years without anyone noticing your strategy until it's too late to copy it. The sixth difference is how they handle leverage. Wall Street gurus love leverage. They use debt to magnify their profits. A typical guru might use 3, 5, or even 10 times leverage because he knows it turns a 10% profit into a 100% one. Jewish investors use leverage, but in a radically different way. They only use it on assets that can survive apocalyptic scenarios. The rule is simple. If this asset loses 50% of its value and I'm leveraged, will it wipe me out completely, or can I survive? If the answer is, it wipes you out, don't use leverage, no matter how safe the investment seems. This discipline has saved them in every major crisis of the last 100 years. During the 2008 crisis, the most famous hedge funds collapsed because they were leveraged into assets that seemed safe but turned out to be toxic. Meanwhile, investors like Sam Zell, nicknamed the Grave Dancer, not only survived but prospered by buying up assets that others were selling off, precisely because they weren't over-leveraged and had cash available to take advantage of the crisis. The seventh difference lies in their relationship with advisors and experts. Wall Street gurus are experts, or at least they project that image. Jewish investors, on the other hand, assume they know nothing and build massive networks of specialized advisors. This isn't false modesty. It's a genuine recognition that no one can be an expert in everything. Stephen Schwartzman, founder of Blackstone, has a simple operating principle. Before making any major investment, he talks to at least 5 real experts in that specific sector. Not financial analysts, but people who have worked in that industry for decades. This humility in recognizing the limitations of one's own knowledge is what has allowed Blackstone to succeed in sectors as diverse as real estate, energy, technology, and healthcare. The 8th difference lies in how they define the purpose of investing. For Wall Street gurus, the goal is to prove they're smarter than the market. It's an ego game where the score is annual returns and media fame. For Jewish investors, the goal is different: to build freedom and security for future generations. This difference in purpose changes everything. When you invest to prove you're smart, you take unnecessary risks to have impressive stories to tell. When you invest to build generational security, you make boring but solid decisions that may not impress anyone, but add up in the long run. David Rubenstein, co-founder of the Carlyle Group, has a quote that perfectly captures this philosophy. Money doesn't make you happy, but lack of money makes you very unhappy. Jewish investors don't pursue happiness through wealth. They pursue the elimination of insecurity. Once they achieve that, every additional dollar is reinvested for the same purpose: increasing security for the next generation. Diversification. Gurus preach, don't put all your eggs in one basket, and create portfolios with 50 or 100 different positions. Jewish investors do something paradoxical. They're highly concentrated in their best ideas, but diversified across uncorrelated assets. Seth Klarman may have 80% of his fund in just 10 positions, but those positions are in completely different sectors: an insurance company, a mining company, a media business, real estate, distressed bonds. If one collapses, it doesn't drag everything else down with it. But within each sector, he's highly concentrated on his best idea, not diluted across 20 mediocre positions. This is the difference between smart diversification and diversification out of fear. Gurus diversify because they don't know which of their ideas will work. Jewish investors focus on ideas where they've done the deep work, but they diversify across asset classes to protect against unpredictable black swans. The 10th and final difference lies in how they transmit knowledge. Gurus write books, sell courses, and give seminars. They share their secrets for money. Jewish investors do it differently. They transmit knowledge only within their families and close circles, and they do so experientially, not theoretically. There's no course to buy, no book to read. Knowledge is passed on by sitting your 15-year-old son in real investment meetings for 5 years. It's passed on by letting your 22-year-old daughter manage a small portion of the family capital with close supervision. It's passed on through thousands of conversations over decades, not through 5 hours of online seminars. This way of transmitting knowledge creates something no course can replicate: judgment developed through real experience. A guru can teach you formulas and strategies. An investment parent teaches you how to make decisions when no formula applies, which is exactly when judgment matters most. What makes all these differences so powerful is not any one of them individually, but the entire system operating together. An investor who thinks in generational terms, who obsessively avoids losses, who values strategic illiquidity, who operates at deeper levels of thinking, who cultivates invisibility, who uses leverage conservatively, who builds networks of experts, who invests for safety not ego, who focuses intelligently, and who transmits knowledge experientially, is not playing the same game as the Wall Street gurus. Gurus play a short-term game where the goal is to impress and the score is annual returns. Jewish investors play a long-term game where the goal is to survive and prosper for generations, and the score is how many future generations will live in financial security thanks to today's decisions. The irony is that this boring long-term approach, focused on survival, consistently outperforms the exciting short-term approach focused on maximum returns. Not in any one year, but over any 20 or 30-year period. And that's exactly the point. They're not trying to win in 1 year, they're trying to never lose over the long term. If this perspective has helped you, support this channel with a like and subscribe to continue learning about investing. See you next time.